Hello, everyone. This is Josh Carr with The Real Angle, and today we are talking to Keir Renick. Keir, how are you doing today?
I'm doing great. Thanks for
Great.
having me on.
Thank you. Thank you for joining me. I know we were talking a little before I started the recording, but I always like to interview people who are doing something interesting, unusual, and that's why I wanted to talk about FarmOp, which is your company. And I always like to tell everyone out there on the internet before we get started, the web address is farmop.com. So if any of you want to check out the website, I always like to put that out there. I'll mention that again at the end of the pod. Let's start with the basics. What is FarmOp Capital?
So FarmOp Capital is an operating lender to farmers. Kind of think larger row crop farmers, your traditional crops, corn, soybeans, cotton, rice, beets, potatoes, things like that. And really, we started the company wanting to focus solely on operating capital because there's a dynamic going on where a large portion of at least the U.S. farm universe rents their ground. You kind of think of a farmer as more of a traditional, maybe even a smaller farmer with a farm that was inherited, and you don't think of it being a rental economy, but it actually is.
Interesting.
And there's a number of problems inside of that create struggles for getting an operating loan.
Right, because if you own the real estate, you could just get a loan against the real estate, whereas if you're renting the real estate, it's more, I guess, like funding an operating business.
That's right. Yeah, if you're asset heavy, right, it fits really well into bank kind of balance sheet underwriting methodology, and you cross collateralize your widgets that you're producing and your AR and your real estate or your plant, property, and equipment, and it's pretty easy to finance from a bank perspective. When you don't have or when you rent the PP&E and you just have the widgets, it's a little harder, right, for the
Right.
bank. Yeah.
And
So
go
yeah,
ahead.
go ahead.
No, I was just going to ask. So, I mean, your competition then, as far as, I mean, you're a specialty lender, I guess. Good way to describe you, I guess. Your competition would be banks, or who, like, where would these farmers be going otherwise for the loan? I guess, if not to you.
Yeah, it's banks and the farm credit system, and I would say it's different depending on the space or the industry sector that you may look at when you look at a specialty lender. So, take commercial real estate as an example. Often the angle is potentially a loan that just can't get done, right? It doesn't mean that the borrower was borrowing at 50% LTV on a project. It may just be a project that doesn't get done because you can't get the appropriate leverage to get the deal done. In this particular case, it's more around the liquidity profile of the farmer. And so we're actually taking farmers out of the banking system and giving them a different type of loan. And so the easy example I often give is if you needed $100 to farm, the bank's probably going to give you like 60 or 65. You're
Sure.
going to go get a large portion of the rest of it from a retailer, a captive finance, input financing type structure, and then maybe they're funding $5 to $10 of that 100. We're really making a stretch loan to fund more like 85 or 90. And we make an overlapping loan because crops are seasonal. But the reality is the operational components of a crop year don't just fit inside the crop year. So right now we're harvesting the 23 crop, but farmers need to start buying all of their inputs for 24. So you
Sure.
have the burden of your project costs, your next year's construction costs inside of this year before you finish this project. And what's unique about what we do, and it's probably unique to the industry, I would say, versus not just what we do. It's very difficult in other industry sectors to go out and be able to create a known outcome, right? So in farming, you have crop insurance that's very robust. It's really almost a public-private partnership, and it's very supportive safety net to the farmer. But you also have hedging, where you can hedge the output, the commodity price. And so those two things together, if you do them right, your widget is pretty well known. And so it allows us to not only go beyond the advance rate of a bank that's looking at the balance sheet, the historical view of asset value, but it's also allowing us to bank next year's, future widgets by locking in price and things like that, and giving the farmer really access to, I think, two profit zones that are taken away from them if they don't have the right liquidity profile. And that's buying their inputs for next year really early because you get discounts, and not selling your grain right at harvest, actually selling later into the year. Because as you can imagine, at harvest, that's kind of the glut of the market. Everybody's delivering. And so your prices are depressed, and the carry in the yield curve is much higher if you can wait out to later months.
Got
But
it.
if you're only given 60 out of the $100 and you're only given one loan at a time, you can't do that. So I would say we're making a stretch loan and two of them with the requirement that there's a heavy risk management plan in place. And we're pulling those farmers out of the banking system and banking them differently versus someone that just isn't going to get the loan.
Now, and I understand a lot of this. So you're giving them a stretch loan. You're lending them more money. You're giving them more flexibility in their timing, which, as you said, gives them better pricing power, both on the going in and the going out, buying the inputs, selling the outputs. Um, and what's interesting to me also is your comment about how, like, you're getting ready for 24 while you're still selling 23, which makes me immediately think about what's your security, right? So if you're lending me money to do the 23 full in, out, the full cycle, the harvest, but then I'm starting on 24, am I getting a new loan for 24? Is my 23 loan rolling into 24? How does that work for me
The
if I'm the borrower?
23 loan doesn't roll into 24.
Okay.
They are liquidated and treated as separate, piles of collateral, if you will.
Okay.
Um, the equity, though, in 23 is essentially contributing to our ability to underwrite 24, as is the assets that you do own. So there are some assets like
Right. So if I
equipment,
make good money
some
in
improvements.
23, I have a better balance sheets, and now we have a relationship. So the logic would be we now do 24 together, because why wouldn't we if we just did 23?
Yeah, I think there's a number of things that go into that mixture, right? Because the question is a very understandable question. So when we think about it, it's not only that we can see the equity in 23, there's boot collateral that our blanket UCC is attaching to on the balance sheet. That's additional collateral. It's typically a family kind of small business, legacy business, that there isn't this idea that you would exit after doing this for 2 or 3 years, right? This is what you do. This is your livelihood. So
You're
there is
still a farmer, sure,
there's
right?
a strong incentive to continue going. So it's not like if we started funding 24, it's likely that somebody's just going to say, see you later. And then there's a cash management component to this. We're only funding a percentage of 24, and it's attached to the inputs that we would have a security interest in. And it would be challenging to go liquidate those things. It's unlikely that the farmer isn't going to plant if we're going to provide the resources to go plant next year's crop. But you do have a decent collateral position for 24. You've managed it through cash management by only funding 30 or 40% of the loan until you actually plant. But it is, I think being on the edge of that, I can see, and that's part of the advantage. Banks aren't going to get comfortable with doing something like that.
Yeah, I mean, because I'm thinking in construction lending, like if I'm forwarding you additional money to keep building your building, I'm having an architect go out and be like, okay, you said you were putting up drywall. Did you put up drywall? Like, to
Yeah.
actually see it and to get the receipts, the rest of it. And I don't want to say you're running this on trust, but to a certain extent, there has to be a little bit more trust than I imagine you have in construction, where you have that extra level. Well, I mean, do you have that extra level of verification? Like, are you verifying they actually planted? Like, or is that just more baked in?
Oh no. Yeah, I would say the verification levels are similar. Maybe the time delay is what's different. So we're direct paying the retailer early, so we know where the money's going. It's
Okay.
not like the money is just being drawn.
Right.
We are verifying planting, all of those things. It's just we could invest in 24's crop as early as August and it not go in the ground until March. We're doing
Right. Just
the same
because.
verification of a construction loan, arguably. It's just there's a time delay where you may have had 30 to 60 days to provide evidence that something's going up, right, for your construction project, where we're more like 3 to 6 months.
Right, because that's just the nature of farming. It's going to
Yeah.
get it's seasonal at the risk of stating the obvious. No, it's interesting. I mean, I don't know if you have a percentage off the top of your head or you'd share, but of your borrowers, what percentage are repeat borrowers? Like once you get them in your system, they're coming back year after year.
Yeah, historically we've had a retention rate of just under 90%. So
That's
it's
exceptional.
yeah,
That's
it's
exceptional.
high.
Yeah, no, it's interesting because when I think about lending, the great challenge with most commercial lending is that's, you go through all this agit, all this work to go make the relationship, you make the loan, and then the guy doesn't come back for 4 years,
Yeah.
because he's
Yeah.
got another project. Whereas with you, okay, maybe you have to invest more time on the upfront to go build these relationships, but if you have that high of a retention rate, once they're in the system, wash, rinse, repeat. I mean, just do your job and execute, and you don't have to go sell them a second time.
Yeah, and
Um,
it contributes to what you'd mentioned, right? How do you get comfortable with doing the next year's loan early, right? It's a very high touch loan. It's both customer service as well as loan servicing slash credit, right? But they kind of contribute to the same ecosystem.
it's interesting. Now
Yeah.
now a few other things we didn't talk about. So you started this business a little over 10 years ago?
Uh, 18. 18
18.
was our, yeah, so
Okay.
call it five. Yeah, five
Okay.
years. Yep.
Okay. And then we didn't talk titles, partners. How big of a team are you?
We, depending on how you count the team, there's probably a core 12 people, and then outside of that, we've gone to a pretty heavy consulting model. Even if you wanted to consider our sales force, consultants are on a commission basis, I'd say there's another 20
Sure.
partners. So, there's kind of 30 people involved in making the thing go around.
And then I guess thinking mechanically, so you're providing financing to farmers. Obviously, in the U.S., that's the markets you're operating in. You're domestic. We talked about pipeline. We talked about product type. Um, Funding for this. I mean, with a bank, they're a bank, right? So are you guys? Is it a fund that you launched a fund and the fund is backing this? Is it an evergreen structure? Like, what's your side of the house look like, so to speak?
Yeah, so the funding of a loan, so any $100 or a dollar, typically 90 to 95% is back levered, either from a bank warehouse line or a securitization vehicle, and then that bottom 5 to 10% is coming from us as the originator and servicer, and that's really funded through a strategic partner. It's not in a fund structure. It comes into the company. It's our working capital. So there really isn't an end in sight like you would think of as a
There's no
fund.
exit date where you get to
Yeah, where
year
you
eight
need
and
to
you cash
harvest an
out.
asset, et cetera, right? Because it's mixed capital and how we run the business, investing in the business, and obviously putting in haircut capital into those loans is a part of the business operations.
Sure. No, it's almost like, yeah, you're syndicating loans. No, it's interesting. I mean, you're basically a bank, but you're not a bank. You're like, I mean, just what you're describing to me sounds like a bank, you in
It
terms of the way the money
Yeah,
flows.
if you think of a bank, right, it's got tier one capital
Sure.
that it puts into a loan, and it has its working capital, and they get leverage from depositors. We don't have quite the same luxury that a bank does at those cost of funds, right? I mean, effectively, a depositor is giving you short-term funds, and a bank is lending it out on more of a long-term basis, and they're as cheap as it gets, right? Depositor
Sure.
funds, especially because they're insured. We don't get that, that same lift, but we don't also have the, I won't say regulatory burden, but we can think outside of the box to come up with different solutions as long as, it logically makes sense to our investors, right?
I would say regulatory burdens. I mean, I've
Yeah.
spoken to people in commercial banking. There is a lot of extra paperwork on top just because, when you get federal insurance, they want to make sure you're not a crook and that you're doing things the way you should. And there's bureaucracy because, of course, there is. Um, no, it's interesting. I mean, we'll say one thing you avoid versus your typical commercial lender, and you mentioned depositors. Depositors, of course, have the risk of, I mean, sorry, banks have the risk of you take short-term deposits, you make long-term loans, and you get squeezed sometimes. In your
Yeah.
case, you're in and out every year, essentially. I mean, you have other risks because obviously commodity pricing changes, but you don't have that sort of duration risk of short and long. I mean, you put it out a dollar, you get it back within a year. You put out a dollar, you get it back within a year. It's more like you're running lines of credit more than anything else.
Yeah, the product, it was particularly well suited for this last environment for really two reasons. Our average term tends to be around 18 months, but that's still pretty short term paper. But
Yeah.
it's also floating rate paper, right? So it's repricing with the market every month. So we didn't have to go through, I think, some of the pain that a lot of people did if you are making longer duration loans. It's challenging, right? In an environment that type of interest rate hiking the curve was going to be challenging for anybody. But I think it was particularly challenging for people that were putting a lot of duration or buying duration on their books, just because that mismatch became real so quickly, and the gap was so big.
No, it's painful.
Yeah.
It's painful.
Yeah.
I don't need to. We don't need to regale. I'm sure we both have stories about how many people got squeezed during some of this stuff. So,
Yeah, I mean, the other thing you have, and it's a challenge on the real estate owner or investor side as well as the bank, is you've got a valuation gap, right? That's created with that type of interest rate move, where you don't really see the same thing if you're not financing land here, you're financing the widgets coming off the land. It's just, we suffered other, pain points because of that environment, but I think the same, or maybe the pain points that are often talked about in the news, didn't hit us as severely.
fair enough.
Yeah.
So one question I always like to ask people, what sort of deals are good but not for you? I mean, you mentioned some of the loans you do. Like, what are the things farmers or farmers have come to you and say, "Will you finance this?" But you just say, "No, thank you. That's not us."
Um, Traditionally, that's been equipment and land, just because we think the market is generally well served and there isn't necessarily a reason we aren't doing anything special for them. So you
They
might
could
as
go to a
well,
bank and just get a loan against the land because it's
yeah,
reasonable.
you might as well get the lowest cost of capital you possibly can. I think,
Sure.
some of that's changed. We do see gaps where we actually are making a few real estate loans here and there for current customers where it makes sense, for what they're trying to do from an expansion perspective. It makes sense in relation to our operating loan, and there's also a convenience factor for them of dealing with one party. But even on the operating side, I would say the credit, it really comes down to a current ratio or a liquidity profile that the borrower is trying to create, or maybe is absent. And you're having to make managerial decisions that are less than optimal because you do not have the right amount of liquidity. That's where we play a role. And you would pay us a premium for us to create that profile for you. If you have a lot of working capital, we just can't do as much for you. And so, we always go into any of these deals looking for, are we adding value and making sure that, our value is priced accordingly to that particular profile.
Right. You have a specialty loan product, and so
Yeah.
if it fits, great. If it doesn't, it doesn't. We talked a little bit about regulatory issues earlier when we mentioned banks, and this is just me being curious. So, you mentioned row crops, right? Wheat, corn, what have you. Um, let's talk about regulatory stuff. Financing cannabis. Could you finance a cannabis farmer? Would there be a regulatory limit or rule that would kick in to say no? Or is it the same thing?
We cannot actually do that. A cannabis, and there is a difference: cannabis versus hemp.
Right, I
Uh,
mean cannabis. I mean the product you smoke, not the thing you turn into shirts.
yeah,
Right,
yeah.
because hemp,
So,
for those of us who don't know out there in the world, hemp, low THC, can't get you high, an industrial product, people use it in all kinds of things, right? Whereas
yep,
cannabis is the thing people smoke,
yeah.
correct? Right, okay.
We can't, in terms of just our agreement, our reps to our banking counterparties.
Your financial part. Okay,
Yeah, that we don't do that. Yeah.
fair enough, fair enough.
Hemp, we actually don't do either for a different reason. There's some risk that hemp can actually turn hot and ultimately become cannabis, and you cross over into the area that you didn't intend to be in. And
Sure.
it's also a little bit of a everything we do, it's based on a risk management plan with crop insurance and hedging. It's just a little trickier on the insurance policy. It's new. It's just not. It's not as well framed in as the other
It's not
crop.
as mature. Corn's
Yeah,
been around forever, whereas hemp production in the United States is still relatively a young industry for
yeah,
fairly obvious reasons.
we're
No,
figuring it out.
that
Yeah,
makes sense. That makes sense. No, I mean, because I always like to ask people like what doesn't work, and I mean, not to harp on the cannabis thing, but it's been interesting because I've had conversations with different parties on different different parts of touching the elephant, trying to figure out what it is, so to speak. The old thing about the three blind men, and yeah, it's still something that we're trying to figure out as an industry because of state and federal laws fighting with each other. What can we and can't we do? Um, so another question I always like to ask, for good or for bad, nothing ever works out as expected, right? Sometimes we get lucky, sometimes we don't. Any fun surprises or things you came across coming in, because this is still relatively new for you. You've been doing this for a few years, but you haven't been doing this for 40. Things that are good or bad, unexpected things that you've encountered along the way.
that's a good question. Yeah, look, I think there was unexpected bad things that happened over the last 6 to 12 months for everybody. I think just that level of uncertainty was difficult. I think probably more on, less related to our assets and more related to capital markets activity around raising for the company, things like that, that were just, naturally disruptive when you think about valuing a company or just getting a deal done. Um, and I think that, that forecast is still a little bit TBD, right? It certainly, if you look at the leading indicators, there certainly seems to be some stability in the numbers outside of kind of the wild cards around politics and maybe geopolitics, right? What's going on in the
Sure.
Middle East. But if you would have asked this question 3 6 months ago, would we have kind of landed where we landed based on Fed policy? I think, boy, it seems like you got to be relatively happy with kind of how people have handled the situation. Um, I think the good and maybe the bad inside of that. I'll just give you a little more detail.
Yeah.
And really, I think of it as COVID as the catalyst to higher inflation than higher interest rates. Right? It was the whole cycle. The good inside of that is it significantly stressed our risk management plans, which I think everybody looked at it on paper and said, okay, you're hedging price, but what happens when stuff really goes bad?
Right.
Well, when people stopped driving and ethanol usage went down and corn went from 475 to 320, like everybody saw the mechanics work, and I think it really validated our model. Um, that was one of the good surprises out of that, from kind of negative stress or maybe just stress testing the model. Uh, I'd say one of the bad surprises inside of that, you had a ton of stimulus. You had actually a rebound in corn prices. You had banks being really stuffed with all of that stimulus money. And we actually felt a lot of headwinds after that in terms of bank competition, because you had really a limited way for banks to get money out of the system other than to go try to figure out a different way to lend. So you had a
Right.
lot of banks really moving into this market. You had a lot of farmers that had tons of stimulus dollars and had less pressure on what would be a normalized system where our loan was really valued more. And I think that's slowly being reversed out as small businesses have been able to spend on capex. Deposits have gone down. Good or bad, you had the SVB component that caused a lot of stress in the banking system. But we're like back to normal loan to deposit ratios. But there for a while, we had a lot of sales headwinds, which is probably a surprise I was never thinking of, you know, as an adjacent side effect from COVID.
Yeah, it's funny. You mentioned SVB, Silicon Valley Bank and blowing up, and Signature Bank. I'm based in the New York, New Jersey market, so Signature's more of our, the one we paid attention to, though SVB was big. And your comments about COVID and the rest of it, it does seem to me like the last few years feel like I'm a sophomore taking macroeconomics, and my econ prof throws out a thought experiment, and you just sort of say, well, that's a great thought experiment for a sophomore class in macro, but like, that's not real, like that would never happen, and then you throw your hand up and you give an answer, and the professor says, great, and then you go back to the class. COVID feels to me like just a giant thought experiment, but we got to live it out. And yeah, it was weird. I'm still finding masks and pockets of winter coats, that I'm like, okay, well, why do I have this? I guess I can throw it out now. I don't, I guess I'll throw them out. I don't know what to do. It's all very weird. It's all very weird.
Yeah, such crazy times. And I, whether it's, I guess, interesting from an academic perspective or just a thought experiment, it was just interesting to see all of the side effects from it, right? Because the system had to react to it. And then the system's reaction created all these other reactions. And trying to get ahead of that, I think, as any business owner, investor, is either there's a ton of opportunity or it can be really frustrating.
There were a lot of unexpected consequences.
Yeah.
A lot of I didn't think the toilet paper manufacturers thought that that was going to result in a mammoth run on their product. You know what I mean? Like, that was not like, whatever their plans were. I'm sure they're like, wow, I had no idea we'd sell that much. So
Yeah,
it's
Purell or
yeah, all those
product,
people.
right?
So a few final points just before we get to the end here. Plans for the next year, 2 years, 5 years? I mean, your entity is running. You looking to grow it? Is there new directions you want to take it in? What's the vision as you go forward?
Yeah, well, I mean, I think on the growth perspective, we've historically grown at almost 100% a year on our book. So
That's
keeping that,
huge.
yeah, keeping that going. And I'd say our primary focus is making the high touch loan more automated and efficient. We're investing in a ton of tech. So that's both limiting, or I shouldn't say limiting, keeping the head count here at a lower head count per dollar out than we've historically been. So where we automate a lot of the high touch component, the data management, and bringing that overall head count or keeping it stable to just per capita per dollar out lower. But also then driving a much better customer experience. They go hand in hand. Everything we do on the servicing side, we try to have a counterpart to that is a good experience for the borrower. We're launching a pretty interesting loan portal that just makes the application process so much easier. It's really about digitizing all of that, giving the customer more value. That's really our focus, I'd say, for the next 18 months to 2 years. It's really tech more than, I'd say, capital markets.
No, that's a great point. I mean, look, I think the consumer expects a certain level of convenience in everything now, be it from banking to their Netflix account. Like,
Yeah.
they want to be able to do everything without actually ever talking to another human being. So
They want it to be easy and they want services. So that's been the focus. Yeah.
That's cool. That's very cool. Well, this has been very good. Closing thoughts? Anything we didn't cover? Anything else you wanted to throw out there?
No, look, you're going to be a professional podcaster in no time. This was great. I,
Apparently so. Thank,
the questions were great.
thank you.
No, I appreciate being on.
Cool.
Thanks for
Well,
thinking of
well,
me.
well, then for everyone, no, excellent, and thanks for joining. So then for everyone who's listening in, again, the website is FarmOp or FarmOp.com, and that was Keir Renick. And what is your title, by the way? Managing Director? What is your title over there?
CEO. It's a little
CEO.
more
Okay.
traditional kind of company titles.
I
Yeah.
didn't know what
Yeah.
the.
No,
I should
no,
have
you're
asked that
good.
earlier.
You're
I
good.
know. Grand Poobah, whatever. My favorite is I'm trying to remember if it's the Joe Boxer people, the underwear people, where the guy who runs it is the chief underpants officer,
Oh
which
yeah.
I always thought was amusing. But Keir Renick, CEO, FarmOp Capital, you can check him out. And thanks again. Excellent.